In principle, what we want to look at is a setting where there are a series of stocks that we can invest in, okay, and at each time unit they're going to increase in value by some multiplicative amount, or maybe decrease in value by some multiplicative amount, okay, and we're going to receive advice from different sources on how you should invest your wealth. What proportions of your wealth should you invest in each asset, okay? And then again, the question is, how well can we do compared to the best advice that we've received, okay? And so that's the kind of problem that we want to consider. But what we're going to start with is a much simpler version of that problem, and that's one of sort of horse racing or gambling on horse races, okay? So the difference here is when you gamble on a set of horses, only the one that's winning is the one that you receive money from, okay? So you could imagine that you've got an amount of money, okay, and you could bet on all of the horses within a race, okay, and the one that wins is going to give you a multiplying factor, but the ones that don't win are going to get you 0, all right? And then you take that money forwards to the next round, reinvest, okay, and you want to try and get as much money as possible by the end of the race day, okay? All right, so that's the kind of situation or setting that we're going to be considering to start with, okay? So we want to consider the problem of sequentially investing in a set of stocks, like I said. However, we'll begin with this horse racing example, okay? So here, we're going to consider a sequence of T different horse races, okay? Each race has N horses, okay? And only one typo, only one horse, not hose, only one horse can win, okay? Now, we're going to let h of t be the unit vector which indicates the winning horse in the tth race, okay? So little h of t is going to be like a vector of zeros and then a 1, okay? And then a number of zeros, okay? With the 1 being in the position of the tth winning horse, okay? So it's just the way I'm going to represent who wins and who doesn't, okay? Further, I'm going to let capital T, capital H of t be the history, in some sense, of the winning horses so far, okay? So capital H of t is going to be, give the winning horse from round t all the way back to round 1, okay? Now, what we want to do is, given the history that we've observed so far, okay, so given capital H of t minus 1, so all of what's happened up until time t, I want to place some proportion of my wealth on horse I, okay? So P of t of I is the proportion of my money that I'm going to put on horse I for winning in the tth race, okay? Okay, and then if horse N, or I, that should be an I, if horse I wins, we multiply our wealth by mt of I. Okay, so that basically gives us the odds of that horse winning, okay, in that betting situation, okay? And if it doesn't win, okay, then we multiply it by 0, okay? So we wish to compare the performance of our prediction policy, PT, okay, with some set of experts, okay, QT, okay? So we can imagine that there's some set, script Q, a sort of pool of people, so maybe they've got, some people have maybe gone behind and have a look at the teeth of the horse and all the rest of it, and they've come up with an opinion about who's going to win, who's not going to win at each race, okay? And they're going to divulge with us what they're going to do, and then we need to decide off the back of that what we think we should do, all right? Okay? Again, we're going to want to compare our policy with the best of these experts, okay? And first we're going to show that we can express this within the framework of kind of regrets, okay? So the first question here is really to argue, okay, that after T races, the ratio between our wealth and the wealth of the best expert in Q is given by the following. Okay? So it's going to be given by the supremum over all the experts of Q of T of H of T. Okay? Now, I haven't really defined what I mean by Q of T of H of T, or P of T of H of T. But really, let's think of this a little bit like a kind of Bayesian setting. Okay? So like, given the past, this is what I think is going to happen next, and then I multiply these things together, and it gives me the probability for the whole sequence of outcomes. Okay? Right? We're not really being Bayesian here because we're not placing any probability assumptions on the winners. But at least for the sake of some shorthand notation, we're going to let Pt of H of T be just the multiple of all the probabilities that I've seen. Okay? Okay, that makes sense. Probability of horse 1 and 2 and 3 and 4 all the way up to T. This is the product of the predictions I had for horses 1, 2, 3, 4 and all the way up to T. Okay? So the ratio of these two things, we're saying, is going to give the ratio of our wealth compared to the wealth of the best expert. All right? Okay, so let's write that down. All right, so that gives us the first answer that we have here. So, well, we just need to look at how much money we make. Okay, so given an initial wealth of C, okay, so that's the amount of money you turn up to at the horse races on the first day. Okay, this is all very appropriate. I don't know if anyone watched Grand National, but the Grand National was on last weekend, so the biggest race in the British racing calendar, horse racing calendar. Okay, anyway, so I've got C units of wealth. Okay, now the amount of money that I invest, or the proportion of that wealth that I invest in the teeth round T in the winning horse, H of T, is given by this. Does everyone agree with that? That's the amount of money I put into the horse. We could say T equals 1. That's the amount of money I put into the first horse. Okay, and then I multiply that wealth by the winning horse by the factor M of T of H of T. Okay? Okay? That's the amount of money I put on the winning horse. That's the amount I multiply my wealth by for the winning horse. And I do that for each time, reinvesting my money at each point. So the total wealth that I'm going to accumulate is going to be that. Okay? So given an initial wealth of C, this is the accumulated wealth. Okay? So if I look at the ratio of the wealth between the amount of money that I get compared to the amount of money that someone else gets, so therefore the ratio between a policy P and a policy Q is, well, it's going to be C product T equals 1 to T, Q of H of T, capital H T minus 1, MT H T, and then assuming they started with the same amount of money that I did, or that's assuming they started with the same amount of money I did. It's going to be the same thing, but with a P instead of a Q. All right? And then you can notice some stuff cancels, yeah? So the ratio between my wealth and their wealth, assuming we start with the same amount of money, that cancels out. And the odds, or the amount of wealth that my money is multiplied by is the same as theirs. It's just that we place a different amount of money on initially, okay? But the multiplying factor is, is the same for both. So that cancels as well, okay? So all we're left with is the product, this product here, okay? So that's Q of t of h of t divided by P of t of h of t, okay? And then obviously, if we want to consider the one that makes the most money, then I just maximize this expression over the sets of experts, okay? So the interesting thing here is that the amount that I multiply the money by doesn't affect things, okay? And the amount of money that I start with cancels out as well, okay? So when we're looking at this kind of prediction framework, okay, all that really matters is the prediction. It doesn't matter the multiplicative factor that I apply to the wealth. It's just, can I predict correctly who's going to win the race? Okay? So the next part is to say that, well, really, this is just can be expressed as, it looks a little bit like a regret. Remember, the regret is the supremum of the winnings of the best person when compared with mine, but usually it's sort of adding and taking away, whereas here we're kind of dividing. Okay, so the obvious thing to do in that setting is then to take logs, and then we go from multiplication to addition, okay, and from division to subtraction. Okay, so argue the next part, which isn't really an exercise, it's just sort of writing down some definitions. Argue that the above ratio can be expressed in terms of regret, like before. So the regret is the amount of money that I lose compared to the person who loses the least, okay? Or alternatively, the amount of money that I win compared to the amount of money the person who earns the most, okay? Okay, and here we're working with a loss associated with the prediction that you make on each horse, okay, is given by, so the loss of my prediction, given that horse H wins, is given by the 1 over the logarithm of the prediction of the winning horse. Okay? So all we're doing here is saying that, this kind of framework that we're considering previously in terms of regret applies to this setting if I want to compare the amount of money that someone's made compared to me. Okay? All right? So the answer to this part is that I just kind of take logs, okay? Okay, so the logarithm of what we had from the previous question, so take logs on exercise 135. So notice this is really going to be log of 1 over P of t of h of t minus the minimum over q log of 1 over q of t of h of t. Okay, and then I can look into each one of these terms. In particular, notice that log of P of t of h of t is really equal to the sum from t equals 1 to capital T of log of 1 over P of t, and my prediction of the winning horse, given what I'd seen so far. Okay, so that's just the definition of this term applied here. Okay. Okay. So what that's saying is if I want to compare the amount of money, the amount of wealth that I gained relative to someone else, so how well was I comparing to someone else, I can phrase this in terms of regret. Okay. Now, we're going to look at a specific type of regret here, which is called the minimax regret. Okay. So that regret was just for a specific outcome, from the horse races, H of t. Okay? Now what we want to do is consider under all kind of eventualities how well is my policy performing. Okay? And that somehow looks over all of the data that can occur over these winning horses and goes, what's the best policy with respect to this set of experts? Okay? So I'm going to introduce the definition of the minimax regret. Okay, so we look at the worst the regret can be, how bad things can get for me under my strategy P, okay, relative to the performance of the experts. So what's the worst thing that can happen, essentially? Okay. So I define this term V of T of P of Q. So this term means what's the worst thing that can happen for my policy P when compared with these experts Q. Okay, so essentially what I'm doing is I'm looking at the regret and maximizing over the sets of outcomes of the horse races. Okay? Okay, so I'm looking over all the things that can happen with the horse races and saying, what's the worst that can happen to me? How much is the most that I can regret this? Okay? And then, so we've done a maximization over the outcomes. Then we look for the best strategy with that considered. Okay? So given the worst thing that can happen, so try to make things really bad, what's the best I can do to mitigate those effects? Okay? So what is the best strategy for the worst case scenario, essentially? Okay? So we look for, with respect to that, we look for the best strategy. So V of T of Q gives us the best policy that I can come up with for the worst case scenario. Okay? Right. Here, V of T of Q is called the minimax regret. Okay? Okay? As a quick aside, has anyone here studied any game theory? Has anyone done... I can't remember, some people said they did economics or something like this in their background. So the kind of minimax framework comes up a lot in kind of adversarial settings. So there's a thing called a two-person zero-sum game, and that's a game where you're essentially taking a bet together, and whoever loses pays some money to the winner. Okay? So the sum of the rewards is zero because for everything that somebody loses, the person who wins gains. Okay, so the sum of the gains versus losses is zero. Okay, so in those sorts of situations, we could think of it like the maximization here is like the environment trying to make things as bad as possible for us. Okay, just as like in a game we were playing, they're trying to make it as bad as possible for me so that they can win their money. Okay. And then subject to them doing the worst thing possible to me, which is them performing their optimal strategy, I've got to try to recoup as much money as possible. Okay? So the main result in two-person zero-sum games is sometimes called the minimax theorem. So minimax is kind of a notion that comes up a lot in game theory. Also, if you've done Lagrangian optimization, duality is essentially minimax result. So it comes up a lot in different settings. Okay, anyway, about minimax. So it's somehow trying to do the best you can given the worst case outcome. All right? And as we'll see, there's actually a unique policy that you can follow that achieves this regret. Okay? So I can give you a way of summarizing the expert advice that you've been given so far so that under all eventualities you do as best as possible. Okay? So that's that specific policy is the following. It's called the normalized maximum likelihood forecaster. Okay. This is the prediction policy as follows, where the prediction that I make over this history h of t, okay, is given by maximizing over all eventualities this q of t, okay, and then dividing by the appropriate normalizing constant. Okay, so from that I can construct a prediction policy under the rule that I just gave you over here. Okay, and then from that I'm going to argue that that achieves the best regret bound. Okay, so we're going to do that for this horse racing example. Okay. So sort of showing that there's a policy that's really quite robust to different outcomes. So it's a good way of summarizing the advice, which is essentially just to look at the maximizing policy, the one that gives the highest probability to that outcome, and that is the ratio that you give to that outcome. Okay. Okay, so let's go about proving that. So the main result we're going to prove is that this achieves the minimax regret. Okay. And the proof isn't too hard. So what we're going to show is that for any class of experts, Q, and integer t, the normalized maximum likelihood forecaster is the unique forecaster such that its worst case regret is equal to the minimax regret. Okay, so the worst thing that can happen to that forecaster is you achieve the optimal. Okay, so what you can do is compare it with any other prediction strategy. Okay, so for some other policy P not equal to P star, well, they're not equal to each other. So there must be some eventuality which gives a lower prediction than our policy. All right? So there exists an h of t such that the prediction of my policy, sorry, the prediction of this policy is less than the prediction of my policy. So why is that? Well, they're both probability distributions. They're not equal to each other. For every so there must be some place that's either bigger or smaller. Okay. If there's a place that's bigger, well, in order for it to sum to 1, there must be some place where it's smaller. Okay. Okay. So let's consider that value of h. Okay, that history. Okay. So V, the worst case regret of that policy P, all right, is the worst under all eventualities. Okay? So the regret that I get from this H must be smaller. Okay? So this is less than the regret at time t of policy P when compared with Q given history h of t, this h of t. Okay? And that is equal to, from our definition before, the way we define the regret, is equal to the maximum over Q of t of h, where this maximum goes over Q, divided by the policy's prediction. Okay, so that's just the definition of the regret here. Okay. And then what I can say is, well, my policy for this H gave a higher weight. Okay. So this is definitely less than the predictions from my policy. Yeah? Everyone agree with that? That's a bigger number, so I divide by a bigger number, so it goes down more. Okay? Then what I can notice is the way I've defined P star is so that it's proportional to this term. Okay? Notice the way I've defined P star is it's already got that maximization at the top. Okay? So that term is going to cancel with that term, and all we're left with is this sum. Okay? So this is equal to the log of that summation, sum over h dash of t, okay, max over q, q of t, h dash of t. Okay? But notice that's the outcome that I get for any history from my policy P star. Okay? So that is exactly the regret, the worst case regret that I have associated with my policy. Okay? So in other words, the worst thing that can happen to policy P is worse than the worst thing that can happen to my policy P star. Okay? That's what that's interpreted as saying. Okay? But of course, this is the minimum. This is defined to be the minimum over P. So therefore, V of T of P star of Q is equal to the minimum over P VT P of Q, which by definition is equal to VT of Q. Okay? So we're done. So it sounded like it's going to be really a difficult result. Okay? It's not that bad. What we essentially see is the worst thing that can happen to this normalized maximum likelihood estimator is the minimum max regret. Okay? I'm not sure if I start up a betting firm off the back of this, but I think it's pretty good policy. Okay? The main constraints around this policy are more about the numerical calculation associated with it. So the kinds of investment strategies that have been implemented try to deal with the kind of computational issues around, say, calculating this normalizing constant or replacing it with some approximation. Okay? All right. Next thing to say is just a kind of observation from the result above, which is worth remembering, is that since we've proved that V of T of Q is equal to P star of Q, notice we'd also calculated what P star as Q was. It's log of this summation, okay, with the maximization in it. Okay? So all I'm saying here is that notice I've got an expression now for this minimax regret. Okay? It's exactly this here. All right? It's just a kind of corollary of the result. Okay, but we'll need it in a little bit. Okay? One other thing to say about this is this kind of way about thinking about investment comes from information theory rather than from stochastic integration theoretical probability. And why is that? Because, well, this is a problem about what we've been considering so far is a problem of prediction. Okay? So what this boils down to is deciding with the highest likelihood possible what is the winning horse. Okay? Now that's a bit like a kind of information theory problem where you're trying to do some data compression or you're trying to send a piece of code over a channel. Okay, you're going to get a bunch of zeros and ones, and you want to predict if it's going to be 0 or 1 in the next round. Okay, or we've got a long vector of zeros with 1, 1. We get sort of an alphabet sent to us. We want to predict with as high a probability as possible what the next sequence, not what the next letter, what the next winner is going to be that arrives. Okay, so that's where kind of information theory comes into this. Okay, all right. So okay, that's horse racing. So that kind of sets us up, gives us an idea of kind of what we're looking at. We're looking at these kind of policies which are quite robust against the different kinds of eventualities that can happen in a horse racing situation. Now what I want to do is consider a kind of policies which are going to be quite robust against the kinds of things that could happen, say, in the stock market. Okay? All right. So now we're going to look at a kind of sequential investment problem rather than a sequential gambling problem. Okay. So we're now going to develop the theory that we considered for a prediction in the previous one, and we're going to consider it for the problem of investment. Okay. So before we were considering prediction, now we're considering investment. Okay. So now I put forward a theory for investment. There's no longer going to be one winning horse or stock. Okay. We're going to consider the goal of maximizing final wealth with respect to a set of reference strategies. Okay, so we're going to be given some strategies of investing in the different stocks. It could be just investing in a single stock, but we could consider more complicated things than that. Okay, where you have some portfolio, where you've kind of balanced between the different stocks. Okay, and within those reference strategies, we want to come up with an adaptive strategy that performs better, or at least as well as the best of those. Okay. So an investor is going to trade over T days, okay, and we're going to consider a market that consists of N stocks, okay, so no longer horses but now stocks, okay. A market vector, S, boldface S, gives the relative increase or decrease in the price of the stocks over a given period, okay, over each period, should we say. So there's T days, and each day S1 is going to give the relative increase in stock 1. So if it's 2, it's doubled. If it's 0.5, the stock price is halved. Okay. For a sequence of market vectors, okay, we're going to let script H of T, so not boldface capital T, but script, okay, denote the history of the market vectors. Okay, so just all the market vectors up until time T. And including T. Okay? A slight typo here. I should have some, this should be pi rather than Q. That's fine. So they're quite fresh, these notes. I've only just written them. So, well, I mean, I wrote them a few weeks ago, but they're kind of fresh. So we'll see how they go for typos. It should be okay. All right. So an investment is a probability distribution, okay, that gives the proportion of 1 unit of wealth invested in each asset. Okay, so you've got £1 or £100 or £1,000 or whatever, you've got to invest it certain proportions into each asset. Okay. Notice that if I do this, this is going to result in an increase of wealth given by S of T multiplied or dot producted with the vector pi. Why is that? Because pi I is the amount of money that I've got in asset I, and SI is the amount that has been multiplied by. Okay, now if I sum that up over all the stocks that I have, that's the total increase in my wealth. Okay. An investment strategy is a sequence of investments. Okay, so the vector pi of H of T is going to be pi of T of I of H of T. So here we're saying I invest a proportion pi T of I in asset I, given the history that I've observed so far up until time T. Okay, so given the history so far, this is the amount of money I'm going to invest in I. Okay, and if you do that for each time, then that gives us an investment strategy. Okay, all right. Now, a bit like before, we looked at the amount that our wealth multiplied by over that period of time. Okay, so the wealth factor of an investment strategy, is given by using sort of script WF. So the wealth factor at time t of a policy pi, given the history, is the total amount I've multiplied my wealth by. Okay, so that's the amount of money I multiplied my wealth by at time t, and then I do that for each time period. I get the total multiplication of my wealth. Okay. Okay. So I just look at the amount I multiply my wealth by from time t to t plus 1, and then I do that for each time, and I get the total multiplication of my wealth. All right? Now, so what kind of strategies can we consider in this framework? Two popular ones. One is buy and hold strategy. Okay, that is an investment strategy where you distribute your wealth according to some fixed proportions, QI, at time 0, and afterwards you don't trade anymore. You just kind of buy stocks and you hold them. Okay? So an initial exercises show here that the wealth factor of this is this. Okay? And it's kind of not too bad to show that. So notice ST of 1 is the amount that I multiply my wealth by. Oh, sorry. Let me get that right. S1 of I is the amount that I multiply my wealth by at time 1 in asset I. Okay? And then I multiply it by this at time 2 all the way up to the final time. Okay? So that's the total amount of money that I've invested in asset I. Okay? That you would get if you put all your money in asset I. But you didn't put all your money in asset I, you only put some proportion QI into it. Okay? So that's the total amount of money that you've got from investing in asset I without changing. Okay? And then you just sum it up over the different assets. Okay? Okay? Is that clear to everyone? I can write a bit more there if you want. That's okay. All right. Another type of strategy which we're going to consider a bit more is one called a constantly rebalanced portfolio. Okay. So a constantly rebalanced portfolio, CR, is a policy that keeps a fixed proportion of your wealth in each asset. Okay. So you kind of go like, I'm going to put half of my wealth in stock A, quarter of my wealth in stock B, and another quarter of my wealth in stock C. And I'm just going to, each unit of time, I'm just going to kind of reinvest so that I keep those proportions. Okay? So something like, I guess, yeah. Okay, I guess if you're kind of following like the FTSE 250 with an equal proportion in each FTSE 250 company, that would be what you would be doing, sort of constantly rebalanced portfolio. Okay. Okay, so a constantly rebalanced portfolio is a policy that keeps a fixed proportion of wealth invested in each asset, and the exercise here says to show that the wealth factor for this is given by the following. Okay. And it's really just a recap from the definition before. So we know that under my policy pi, the amount that I multiply my wealth by at time t is pi times s. Okay, and here I've said pi is fixed. All right, so I'm not changing the proportions that I'm doing. So I just multiply up the wealth that I get from each round. Okay, so here pi of t of I given h of t minus 1 is just equal to f of I, and the increase in wealth at time t is f of t times the vector s. Okay? And then, so if I want to do it over all time, the total increase in wealth is the product of all these guys. Okay, just the product of those. I should have a little t there. Okay. All right, and probably time for just one more definition, and then maybe, yeah, one more definition. So here we're going to look at the same notion as before, the minimax regret. Okay, so for a class of investment strategies, okay, so we're going to have some advisors who are going to say, oh, you should follow the FTSE 250, oh, you should invest all your assets in oil, I don't know, whatever, yeah? Okay, and we want to look at how, when I take in that advice and I balance my wealth between the different pieces of advice, how can I follow a policy that makes the best multiplicative increase in my wealth, okay? So for a class of investment strategies I, the regretted investment strategy pi, similar to the previous definition we had before, is going to be how the log of the wealth factor, my wealth factor, how that compares to the best wealth factor, okay? And notice in this setting it makes a lot of sense to take logs because I want my rate of return to compare my rate of return compared to their rate of return. I don't care about absolute wealth, I care about rates that I get, yeah? So if they're making 5% year on year, I want to be making 5% year on year, okay? So that's another reason for taking logs when considering these things, okay? So you're looking at who's getting the best rate of return, who's getting 5%, who's getting 10%, who's getting 2%, and you want to look at what I'm getting, okay? And I want mine to be as close to, if not bigger than that, right? Now, again, the minimax regret, this is with respect to a specific history, okay? So given what's happened in the past up until time t, all right? The minimax regret, again, looks at what is essentially the worst thing that can happen, given the sort of different stock market eventualities and all the rest of it, and look at how that compares with a specific policy pi, and then I look to find the best policy pi. So given all the eventualities that can occur in the market, what is the best performing policy? Okay, can I construct a policy that is robust to the different eventualities of the market? So given all the things that can happen, can I summarize the advice that I've been given by the different experts or whatever in order to get the best rate of return? Okay, so we're going to work on comparing this WT of I compared to what we had previously, which was V of T of P, okay? So I want to compare what is the minimax regret for investment and compare that with the minimax regret for prediction, okay? And the main result we're going to prove is that actually, say, for constantly rebalanced portfolios, the investment problem is exactly as difficult as the prediction problem, okay? The investment problem seems like a harder problem because, well, you've not just got one winner that determines everything. You've got several winners and you've got to balance between these, okay? So it's not like yes, no, it's a bit more complicated than that because you've got sort of averages between the different ones that can occur. It could be two winners, you know, okay? Yet still, for constantly rebalancing portfolios, we can find that actually investment and prediction are equally difficult problems. And we have a solution for prediction in terms of this normalized maximum likelihood one. So we've got essentially a solution for going about implementing and getting the best rates of return, regardless of eventualities, for investment problems. Okay? Okay.